This is Nightly Business Report with Bill Griffith and Sue Herrera.
Hiring bounce back. Employers add more jobs than expected, easing some concerns of a coming recession, at least for now.
Dislike button. Most Americans say they have soured on social media, and yet they can't give it up. And that may be exactly what the companies want.
Everything is coming up roses, especially for one entrepreneur who had the bright idea to give flowers a second life. Those stories and more tonight on Nightly Business Report for this Friday, April 5th.
And we do bid you a good evening, everybody, and welcome. America's job engine was back at work last month. Hiring rebounded in March as employers added to their ranks, despite some concerns that the economy may be starting to slow a bit. 196,000 non-farm payroll jobs were created last month. That was a bit stronger than it was expected. The unemployment rate held steady at 3.8%, and wages ticked slightly higher. Now, this report took on greater importance after February's especially anemic number had many asking if the hot economy had suddenly cooled off. Ilan Mui starts us off tonight.
Winter weakness melted away in March, and America's job market rebounded. The strong showing is a relief to investors. They were caught off guard when hiring dropped off in February. And today, President Trump cheered the bounce back as he left the White House for a visit to the southern border.
The country's doing really, really well. We have a lot of very exciting things going on. A lot of companies will be announcing shortly they're moving back into the United States. They're all coming back. They want to be where the action is.
In March, the biggest job gains were in the healthcare sector. It added 49,000 jobs. Hiring also picked up at restaurants and bars, which added 27,000 jobs. But some key industries did contract last month. Manufacturing lost 6,000 jobs, and retail was down nearly 12,000. And the share of people in the labor force also edged lower, falling from 63.2% to 63%.
If you want the economy to grow faster, you have to do something to increase productivity and increase labor supply. And one thing we saw in this morning's employment report is labor supply actually came down, and that's really the critical shortage in the U.S. economy right now. We don't have enough workers, even if we had more demand.
The worker shortage is translating into good news for wages, though. Average hourly earnings rose 4 cents to $27.70, and they've grown by more than 3% over the past year.
We're running out of workers, and so that will put upward pressure on wages as well, which makes it better for workers.
Economists say the key question now is, how much longer can this run last? For Nightly Business Report, I'm Ilan Mui in Washington.
Let's turn now to Jeremy Zirin for more analysis on today's job report and the economy. He is the head of investment strategy at UBS Wealth Management Research. Jeremy, welcome. Nice to have you here.
Happy Friday, Sue.
I think and to you as well, I think the key question that Elon left off with is also a key point in your report. How long can we keep generating this many jobs?
Yeah, we think that generally the labor market remains healthy. Demand for labor remains strong. I mean, it was very clear from the snapback we saw in March's payrolls that the very weak number we saw in February was a one-off. And if you look at the mosaic of economic indicators we saw this week regarding employment and employment trends, most were generally positive. The ISM employment index for manufacturing rose. We saw that initial jobless claims reached 50-year lows, so the pace of firing or laying off workers is at very anemic levels. So in general, while I'm sympathetic to the view that we're seeing a little bit of a labor shortage, demand for labor continues to improve, and labor force participation rates, particularly among those above 65 years old, continues to increase, and that's keeping a lid on overall wage levels.
But this shortage of workers, it just seems incredible that we keep hearing about this even as the demand continues to grow. At some point, though, does that ultimately cap growth in the economy if we just can't find enough workers to keep the productivity going?
I think, Bill, that at some point it does, but we're just not there yet. I mean, if you look at the trends in hiring we've been hearing about the worker shortage for the last 2 to 3 years. And over the last 6 months, we continue to see an average payroll gains of 206,000, no different from the trend of the last 8 years of about 200,000 per month.
What sectors do you think basically are going to lead us as we continue to create all of these jobs? Where are you most bullish in terms of economic pockets?
So I think you have to think about, the economic realities and also from a market's perspective and sectors related to the equity market. And from an equity market perspective, we're most bullish on the technology sector where there's lots of job creation, and also the financial sector where we see very low valuations and we see an extension of the economic cycle surprising investors to the upside.
And one last thing here to underline, there have been fears that maybe we are slowing down. There had been talk maybe we'd see a recession later this year. The Fed would have to cut rates. You don't think that's likely this year, right?
It doesn't seem that way, right? I mean, I think that, yes, the wage pressures aren't terribly acute, but overall, we are seeing reasonably healthy demand for labor. And more importantly, it does just give us greater confidence that the softness that we saw in first quarter economic data is likely to rebound in the second quarter, and that should take a Fed rate cut off the table for the remainder of the year.
All right, Jeremy, thanks so much for joining us. Jeremy Zirin with
Thank
UBS Wealth Management Research.
And this morning's not too hot, not too cold jobs report did help lift sentiment on Wall Street today, and it sent the S&P 500 higher for a 7th straight session, making it the S&P's longest win streak since 2017. When we closed, the Dow was adding 40 points. We're at 26,424. The Nasdaq rose 46. The S&P added 13. And for the week, the major averages were all higher, making this 2 straight weeks of gains.
Boeing will cut production of its 737 MAX aircraft by 20% over the next several weeks. The world's largest aerospace company is moving from a production rate of 52 airplanes per month to 42. The company had been planning to increase production to 57 in June. The decision follows the global grounding of the jet in the wake of 2 deadly crashes. Boeing says it's also creating a committee to review the design and development of the airplanes. News of the production cut caused the stock to dip initially in extended hours trading.
And Samsung had a warning for investors this morning. Its profits may have plunged by 60% during the first quarter. The company says a glut of semiconductor chips and rising competition in the smartphone market could lead to its lowest quarterly profit in more than 2 years. Samsung supplies memory chips and screens for its own smartphones and for Apple devices, and its semiconductor business is its main profit driver.
Apparently, Americans hate social media, but they can't give it up. That is the finding of an NBC News Wall Street Journal poll. 35% say social media brings people together. 57% say it divides us. 31% say it helps spread news and information. 55% say it spreads lies. But while adults across age groups and political ideologies have a negative view of the effects of social media, 70% say they still use the platforms at least once a day.
But why should someone want to invest in these companies if they hate them so much? Joining us tonight, our friend Eric Gordon, professor at the University of Michigan's Ross School of Business. What a dichotomy we have here, Eric. I mean, this sounds like a business program that would be studied there at your university. So what do you make of this dichotomy right now? We hate them, but we can't let them go.
We hate them and we can't resist. It's a form of addictive behavior, where even though you know your behavior is bad, even though you know your behavior is killing you, you just can't resist. What Facebook and Twitter and these folks have come up with is something that's so addictive that we can't help ourselves. What a great business model. Even if people know it's bad, 70% of the people still use it.
But does that mean that how should an investor look at those numbers that we just rattled off? Does it make the social media companies a good investment because we can't live without them, or a bad investment because we hate them?
I think it depends on your time frame. I think for the time being, they're going to continue to be a good investment, but I think you've got to keep your eye open, because I think the danger is going to be not that we stop our addictive behavior. I mean, we're just not very good at it. But the government will step in, and the government will have support from the folks who say, look, we know this stuff is bad. You got to do something about it. And the business models that create the profits could take a good whack.
And even Mark Zuckerberg came out this week with that op-ed piece where he outlined 4 areas where he feels the government should regulate their business, the social media business. Does that necessarily mean that it will put a cap on growth, though, do you think?
Well, Bill, that's a good point. What that shows is that Zuck is worried. He's trying to get the regulation channeled the way he wants it. You know, it's like a freight train is coming and he wants it switched to a track that doesn't run him over. That's a sign that he's worried about regulation, and he would like to channel it in a way that's benign, not deadly.
You know, the numbers were pretty striking, but are there other areas or other types of companies that we can compare where maybe people don't think the products are good for them, but they still invest in the companies?
You know, think about soda. Think about cola. We know it leads to obesity. It's bad stuff. It makes you crazy. And can we help ourselves? I mean, you know, the cola companies have done really well. And I guess the most horrible example, to some extent, is tobacco has for a long time been a good investment, good company, not so much. So, you know, the dichotomy between what we know, social benefit, and returns to investors, you know, sometimes they go in opposite directions.
Indeed. Eric Gordon with the University of Michigan's Ross School of Business. Always good to see Eric. Have a good weekend.
My pleasure.
Time to take a look at some of today's upgrades and downgrades. Intel was downgraded to market perform from outperform at Wells Fargo. The analyst points to weaker semiconductor demand along with increasing competition from AMD. The price target is $60. The stock fell a fraction to $55.60. Fellow Dow component Dow was initiated with an underperform rating over at JP Morgan. That's making this the first bearish call on the newly independent company. The analyst says the stock trades at a premium to its peers, and that creates risk for the shares. The price target is $49. The stock fell 4% to $57.24. Boston Beer was downgraded to sell from neutral at Goldman Sachs. The analyst cites concerns over growth and increased competition. The price target is $245. The stock was down 5.5% to $268.33.
Ford was downgraded to reduce from neutral at Nomura, with the analyst there citing challenges in the European car market right now. Price target now $7.50, and that stock finished up 1 penny to $9.25. Bed Bath & Beyond was upgraded to equal weight from underweight at Morgan Stanley. The analyst cited activist investor interest in that company, which could result in a higher stock price over the near term. And that price target is now $20. Shares rose 4% today to $18.35.
Still ahead, adding some retail stocks to your shopping list. A top-rated fund manager has some names to share. The head of the world's biggest hedge fund calls income inequality a, quote, national emergency. Ray Dalio released a report in which he links lower high school graduation rates to the widening wealth gap. He says not educating young children is the equivalent of child abuse and is economically stupid. He is advocating for an increase in investments in early childhood education, per pupil spending, infrastructure, and public health measures.
Now to housing. Imagine taking cash out of your home without incurring any debt and therefore no monthly payment. Well, that's what one business aims to do, but there is more to it than that. Diana Olick explains.
Greg Hart was house rich but cash poor, and he wanted to pay off some debt. He did not want a home equity loan.
To go with a regular HELOC meant I was trading one payment for another, and I didn't see that was going to get me any further ahead or pay off.
Instead, he went with a new idea from a new company, Point. Point helped him to sell equity in his home to an investor, $50,000 cash.
It was one of the easiest processes I've ever done, especially with regards to, say, a refinance for a mortgage.
Eddie Lim had the same issue getting a loan, which is why he started Point.
But the irony is the biggest asset that I own, the biggest asset that most of us own in our lifetimes, all we can do is add more debt. So that's where Point came in.
Here's how it works. Let's say the home is appraised at $1 million. Point lowers that value, say by 15%, so it's now $850,000. That gives Point a $150,000 cushion against risk. Then Point gives the homeowner, say, $100,000 cash. The owner has up to 10 years to return that cash, but can exit the contract at any time. When the owner does, Point gets the initial $100,000 back, plus a percentage, say 30%, of any appreciation in the home's value. And here's where Point can profit. Since it lowered the value to begin with, it automatically gets 30% of that $150,000 cushion, or $45,000. If the value goes up, Point gets more.
The homeowner gets liquidity, the investor gets a risk-adjusted equity investment.
Kingsbridge Wealth Management has pledged $100 million to back Point's contracts.
As an investor, we do expect equity-like returns because we're taking equity-like risk. If the home price goes down, we participate in that, where your mortgage lender does not.
If the home goes up, that's when Point does well. If the home goes down in value, then nobody really does well.
Lim says demand has been very strong. They've invested in 300 homes in 15 states so far and expect to do 10 times that in the coming year with the new cash from Kingsbridge. Greg Hart said he understands that getting the money now is more expensive than a second mortgage because it will cost him more equity later. But
I can now see light at the end of the tunnel, and I'll be able to do things that we've long needed to do. It's just like we're moving again. We're moving forward again.
For Nightly Business Report, I'm Diana Olick in Washington.
Operational issues hurt Duluth Holdings, and that's where we begin tonight's market focus. The workwear retailer missed on both earnings and revenue. The CEO said the company experienced inventory problems, which led to distribution and sales issues. That also increased costs in its most recent quarter. Duluth shares lost a quarter of their value today. They fell to $17.60. Amazon is making a dent in Google's ad search dominance. According to the Wall Street Journal, WPP, the world's largest ad buyer, spent about $300 million on Amazon search ads last year. 75% of that money came from Google's search budgets. Amazon rose 1% to $1,837.28. Google parent Alphabet dropped a fraction to $1,211.45.
Greenbrier has lowered its earnings guidance for 2019, with the railcar maker also reporting profit that was below analyst estimates for its most recent quarter. The CEO described the quarter as underwhelming and said he believes it is a one-off. Greenbrier was off about 1% to 33.01 today. And the judge who is reviewing the Justice Department's settlement that allowed CVS to merge with Aetna last year is now planning a week of hearings in May, and they will include live witness testimony from critics of that merger. Judge Richard Leon has been tasked with deciding whether the merger settlement was in the public interest, and a lawyer for CVS called the request for live witnesses unprecedented. The stock rose 1% today to $54.06.
It is time for our weekly market monitor, who sees growth opportunities in the consumer sector. This is her first time on the program, so we welcome Barbara Miller, a portfolio manager at Federated Investors, where she manages the 5-star rated Kaufman Fund. Welcome, Barbara. It's a pleasure to have you here.
Thank you for having me.
You are a growth investor, and you're looking at the retail and consumer sector because you say there's been a lot of disruption there. Your first pick is TJX companies. Why do you like that?
Well, there has been disruption, but off-price retailers have continued to take market share, and TJX is the largest. Off-price retailers offer extreme value, and as there is disruption in the retail channel, it creates a lot of excess inventory in all over the place, different kinds of brands that these companies can buy. TJX should grow mid to high single digits, and it's also very cash rich, so the company pays a dividend. In fact, just increased the dividend 18% recently.
Lululemon, of course, they're famous for women's athletic, the yoga pants and so forth, but they're finding more growth with men now, aren't they?
That's right. That's a very difficult thing for a women's brand to do, and Lulu has been doing it. Men's is now about 20% of their business, and it should grow even faster than the whole. They're also growing in Asia and in Europe, and their product development is terrific. Consumers will pay up for functional fashion, and Lululemon definitely has it.
Now to the food sector, Wingstop. It's the quick serve sector, right?
That's correct. The quick serve sector is taking market share as consumers are looking for convenience. And Wingstop is really a unique brand. It's growing rapidly. We think from about 1,250 units today, it can have over 6,000 units in the U.S. and abroad. I mean, chicken, everybody eats chicken all over the world. This is a company that is adding national advertising to boost the brand. They're migrating their customers from phone to digital ordering, which adds to the order size and is more efficient. And they're rolling out delivery across their system in the U.S. this year, and that's also incremental business. So this is a terrifically well-run company.
Briefly, are these three companies special situations, or do you just like consumer-oriented companies right now?
Well, we're growth investors, as you said, and we look for companies that are gaining market share, either by virtue of a strong brand or a channel, as in TJX, where customers want to go for value. And in the case of Wingstop, they have a unique brand. So we look at things from the bottoms up at Federated Kaufman, and we look for companies that can gain market share on a sustainable basis, regardless of the overall environment or, frankly, the overall economy.
On that note, Barbara, thanks so much for joining us. Barbara Miller
Thank you.
with Federated Investors.
And coming up when the party's over, what happens to all those beautiful flowers? You can meet the entrepreneur who's not letting them go to waste. It's tonight's Bright Idea.
Here's a look at what to watch next week. On Tuesday, the Senate Finance Committee holds a hearing on prescription drug prices. On Wednesday, the Federal Reserve will release the minutes of its last meeting, where policymakers left interest rates unchanged. Also on Wednesday, bank CEOs will testify in front of a House committee, and that is what we're watching for next week.
Finally tonight, flowers, of course, are perishable, but after certain events, many are just tossed out, even though they are still in perfectly good shape. And if they go to landfills in plastic bags, they can create methane gas, and that potentially harms the atmosphere. So that's why one New York City entrepreneur got the bright idea to touch some hearts while giving flowers a second life. When the lights go on and the guests go home, what happens to the flowers? Well, usually they're tossed in the garbage, bound for a landfill.
I was pushing cart after cart of flowers to the loading dock, and I realized this is ridiculous, and it broke my heart. I couldn't do it anymore, and I decided I was going to be the person to do something about it.
Jennifer Groves spent 7 years as an event planner. She has seen flower budgets that cost tens of thousands of dollars.
What else would you spend that kind of money on and throw out in the trash after 2 or 3 hours?
Her thinking became, why not donate them to hospitals, patient residences, nursing homes, anywhere they might provide a lift. By 2015, with her dad helping out, a customer paid her to deliver flowers to a hospice. Soon, her company, Repeat Roses, was making donations and then returning to bring old flowers to a composting site.
It makes everyone feel really good, and you're getting a charitable tax credit. If they get that return on investment, it's worth it to them. There's a value there.
Her fee starts at less than $2,000. It's still a family affair. Grove's daughter Callista helps out, but their Midtown Manhattan basement office is a command center. Repeat Roses connects contractors and handles logistics for thousands of events per year, from small to celebrity. One week in February was especially busy.
On the East Coast, we were working on behalf of the Duchess of Sussex to repurpose all the flowers from her baby shower. Simultaneously, we were on the West Coast repurposing flowers from the Vanity Fair Oscars party. We were just in the news for Gwyneth Paltrow's wedding.
The Blossom Bar is becoming Repeat Roses' biggest revenue driver, giving the employees at community-minded companies a chance to rescue flowers.
It's leftover excess inventory that otherwise would have wound up in the trash.
The Real Deal, a real estate news outlet, gave employees a chance to share some wine and create flower arrangements.
You're going to cut your stems on an angle.
Repeat Roses has conducted 100 Blossom Bars. Costs range from $5,000 to $100,000.
We get invited to balls and galas and stuff like that, but it's not really hands-on. You're just writing a check. Here in this case, you actually have the people in the office, coming together, giving back to something that makes everybody feel good.
I grew up having old people come in and out of my house all the time, and this would just be something that they would absolutely love.
That evening, Grove's team brought the arrangements to the Hope Lodge, an American Cancer Society residence for patients and caregivers.
Thank you. It's our pleasure.
And they collected the previous week's delivery for composting, a sustainable cycle that Grove hopes can bring a spring-like renewal to the industry.
Our mission is to really figure out how to make it more efficient and how to make it more feasible for people to participate. It's just such a touching moment, and we're able to deliver that to somebody else and create some happiness in the world.
Repeat Roses says it has repurposed almost 50,000 bouquets since 2014 while diverting more than 80 tons of floral waste away from landfills. A little something to think about there as we approach Earth Day, which, by the way, is coming up April 22nd.
All right, before we go, here's a look at the final numbers on Wall Street. The Dow Jones Industrial Average added 40 points to 26,424. The Nasdaq rose 46 and the S&P 500 gained 13. For the week, the major averages were all higher, making this 2 straight weeks of gains. A good way to go into the weekend.
Indeed.
That'll do it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great weekend. See you Monday.